Today, we're going to unpack a pretty wild economic forecast. It's a scenario that could lead to something called a donut-shaped boom. And yeah, it's as weird as it sounds. We're talking about a situation where financial markets are absolutely flying, but the real economy, the part with jobs and local businesses, gets completely hollowed out.
So, everything kicks off with this one question. I mean, it sounds totally impossible, doesn't it? Like some kind of financial magic trick. But the controversial strategy we're about to get into claims it can do exactly that. Let's see how.
All right, to figure out where things could be headed, we actually have to take a look back in time. This whole plan, which has been nicknamed a Trump Shock 2.0, is basically a modern reboot of a huge economic move from 1971. But this time it's aimed at today's massive government debt.
Okay, so the core idea here is something called gold revaluation. The easiest way to think about it is this. The government decides to finally update its old, dusty accounting books. It's sitting on a mountain of gold, but on paper, it's valued at a price from decades ago. This whole strategy just says, hey, let's value it at what it's actually worth today.
So how in the world does this actually work? Well, the secret is all about the gigantic gap between the official historical price of U.S. gold and what it could be worth on the open market right now.
The concept itself is almost deceptively simple. This isn't about finding more gold or selling any of it. Nope, it's just an accounting change, literally updating a number on a spreadsheet. But the ripple effects from this one tiny change could shake up the entire global economy.
And here's where it gets really mind-boggling. Look at the sheer scale of this difference. On the books, the U.S. values its gold at just over $42 an ounce, making the whole stash worth about $11 billion. But if you revalue it to a hypothetical market price of, say, $5,000 an ounce, that exact same pile of gold is suddenly worth $1.3 trillion.
And just like that, you have a paper profit of $1.2 trillion, created in an instant. And get this, without a single new tax law needing to be passed. It's like money just appearing on the government's balance sheet out of thin air. So the big question is, how do they actually get their hands on it?
Well, this is where it gets really clever. This whole maneuver could potentially sidestep all the usual political fighting in Washington. See, the profit doesn't go into a normal government account. Instead, it goes into something called the Exchange Stabilization Fund, the ESF. Think of it like a special wallet controlled directly by the Treasury Secretary, which can be used without needing a vote from Congress. So now the next domino is ready to fall. With $1.2 trillion in its back pocket, the Treasury can kick off its own massive economic stimulus. This is basically a form of quantitative easing, but one that's controlled by the administration itself, not by the Federal Reserve.
This move sets off a really powerful chain reaction. The government starts buying back its own debt, which pumps a huge amount of cash into the financial system. That drives down borrowing costs for everyone. And because there are suddenly so many more dollars floating around the world, the value of the dollar itself starts to drop. And this is where the story goes global. That tidal wave of cheap dollars eventually crashes onto the shores of other countries, including South Korea. But here's the thing. It doesn't create a simple, straightforward boom. Instead, it creates this very strange, paradoxical situation that some economists are calling a donut-shaped economy. What on earth does that even mean?
It's actually a really powerful metaphor once you get it. Just picture a donut. That sweet, sugary outside, that represents the financial markets, the stock market, asset prices. They're all booming. But the center, the hole, that represents the real domestic economy. It's empty. It's shrinking as factories close up and jobs start moving overseas.
So on one side, you've got all the signs of prosperity, right? A soaring stock market, huge corporate profits. But on the other side, you see the hollowing out. You have economic growth, but no new jobs. And you have companies investing their billions abroad instead of at home.
So let's really break this down. Who actually wins and who loses in this weird donut economy? We can see the effects playing out across three key areas: the currency market, the stock market, and in the strategies of the country's biggest companies.
First up, the currency market. Now, with a weaker dollar, you'd probably expect the Korean won to get a lot stronger. But it's not nearly that simple. The market basically becomes a battleground for these incredibly powerful opposing forces. You've got foreign money flooding into the country trying to push the won's value up. But at the exact same time, Korean companies are selling won and buying billions of dollars to build new factories in the US. These two giant forces are pushing in opposite directions, and the result is a really volatile market where the currency doesn't get as strong as you'd think. Okay, next, let's look at the stock market. All that foreign money has to go somewhere, and it could easily spark a massive supercycle in Korean stocks. The problem is, the wealth this creates doesn't really trickle down because the actual investment in new jobs and factories is all happening somewhere else.
I mean, look at this. The real money for building new factories and creating jobs is going to places like Texas and Georgia in the US. It's not going to the industrial heartlands in Korea like Pyeongtaek or Ulsan. So even as these companies' stock prices are soaring, the actual job creation is happening thousands of miles away.
So finally, this all creates a bit of a puzzle. If Korean companies are building expensive new factories in the US and they're facing high tariffs, how could they possibly stay profitable? Well, the answer isn't about cutting costs. It's about crushing their competition.
What happens is that this whole scenario actually weakens their main rivals from Japan. This allows Korean firms to become so dominant in the global market that they gain something called pricing power. Basically, they can just raise prices for their cars, their chips, their ships to cover their higher American production costs, and we, the consumers, have very little choice but to pay up.
And all of this leaves us with a final, really thought-provoking question. Can we honestly call an economy prosperous if the stock market is hitting all-time highs, but it's not creating jobs for people at home? This donut economy idea really forces us to stop and rethink what economic success actually looks like, and more importantly, who it's really for.